Right, welcome to our revision on IAS 37. Before we start, I just want to explain to you the revision page and the layout of this page. Now, IAS 37 focus on the following three categories. One, provisions. What is a provision? When to recognize a provision. Then, what is contingent liabilities? And number three, what is a contingent asset? Therefore, when you look at our revision page, you will identify that all of the gray blocks relate to provisions. Therefore, first, we will discuss what is a provision. Then we will move on to future operating losses, restructuring, reimbursements, and onerous contracts. You will also identify the disclosure section is included in yellow, and our IFRIC 5, guys, this is in terms of our level 2 students, and this section will be self-study. However, I have included all of the relevant important details in terms of IFRIC 5. We will now focus on a provision. What is a provision? Now, in terms of the definition in your IAS 37, it indicates to us that a provision is a liability of uncertain timing or amount. Okay, so guys, just stop right there. When you open the definitions in your IAS 37, in terms of a liability, you will identify that it still refers to our old conceptual framework, where we have a present obligation due to a past event that will result in an outflow of future economic benefits. Now, the main difference, guys, in the new conceptual framework, this outflow of future economic benefits is replaced by the word there has to be an obligation to transfer resources. Therefore, do you see the focus on obligation? There has to be an obligation. Okay. Now, in terms of our provision, what is a provision? It's first a liability, and then there has to be uncertainty in terms of our timing or event. Now, when we look at the liability, your liability will be when there is a present obligation due to a past obligating event, an event that happened that resulted in an obligation. 2, 3, transfer resources. There has to be an obligation that resources will be transferred. And when you look at your present obligation, remember your present obligation, this can either be a legal obligation or constructive obligation. Now, when we refer to legal, remember this will be an act, and therefore there is an obligation. Now, basic example, we have a company registered in South Africa, therefore we need to comply with our South African Companies Act. Based on this, we need to pay our Sub-C annual fees. Now, at the end of the year, if you have identified that the Sub-C annual fees outstanding due to a past obligating event, the past obligating event is the fact that the entity registered a company in South Africa and it has to comply with the Companies Act. We need to recognize a provision in terms of those outstandings. When we refer to constructive obligation, this will be when there is a certain action by an entity or an individual that will result in an expectation. And that's the important word, guys. It creates an expectation to an individual or a company to receive a resource. Then this is a constructive obligation. Okay, so once you have asked yourself the question, is this a liability in terms of our conceptual framework? And this is yes. You will have to refer to your recognition criteria in terms of IAS 37 paragraph 14. And this indicates to us, again guys, there has to be a present obligation, guys, either legal or constructive, due to a past event that will lead to an outflow of future economic benefits, and the amount should be reliably measured. Okay, now when we look at a present obligation, guys, let's just quickly recap. Present obligation, what is this again? There is no realistic alternative but to pay. I'm going to include this. There is no realistic alternative but to pay, to transfer resources. And the key word, guys, please include this. The key word that you need to use in your theory questions is has to be probable. The outflow, probable. It has to be probable. Now, what is probable? This is more likely than not. It is more likely to happen than not. It is more likely that we will have to pay that entity than not. Okay. Now, reliably measured. Now, this is the difficult section because you will have to use your professional judgment in terms of reliably measured. Okay, so you have now indicated that, yes, we meet the liability definition. Then, do we meet our recognition criteria in terms of paragraph 14? Yes. Okay, but how do we address the uncertainty? And remember, guys, in a theory question, you need to bring this in as well. You need to mention what is the uncertainty. Is it the timing and why, or is it your amount? But in terms of this uncertainty in the amount, how will we address this? We will have to measure and use the reliable measurement, and this is the best estimate. And important, when you look at the best estimate, you need to please remember for me that you will have to use your pre-tax, spelling there, guys, pre-tax discount rate, number 1, and number 2, it has to be a market related estimate. Okay, guys, important, focus on market. Remember, when you refer to IFRS 13, we also indicate that it is a market. It's not entity specific in terms of estimates. Pre-tax and market. Okay, now let me just quickly recap in terms of a theory question. I'm going to use pink. In a theory question, you will have to apply your principle. It's the liability. Therefore, you need to apply and conclude, is this a liability in terms of your conceptual framework? If yes, you need to move on to your IAS 37 recognition criteria, paragraph 14. If yes, you need to please remember to mention the fact that there is uncertainty in terms of either the timing or the amount. And then, guys, you need to conclude on this to indicate that, yes, we will recognize a provision, and you need to indicate how. Journal and disclosure note. Then a quick one. What will happen if there is a change in your estimate? You need to identify that you will have to apply your IAS 8 change in estimates, and this should be prospectively. Therefore, prospectively, you need to know that this needs to be corrected in your current year and then future years. Guys, this is important, especially from a theory question. Okay, now let's move on to our future operating losses. For future operating loss, do you think we recognize a provision? No. Why not? Because it does not meet the definition of our liability. Remember the definition of your liability, there has to be a present obligation due to a past event that will result in an obligation to transfer resources. Now, a future loss, guys, what is the obligation in terms of that? We know that there is going to be losses. Okay, now it doesn't meet the definition. Therefore, we will not recognize a provision. But it is important that this can be an indication of possible impairment, and you will have to apply IAS 36 and test for a possible impairment. Right, let's focus on restructuring. Okay, so when we look at restructuring, the standard indicates to us that a provision for restructuring costs is recognized only when the general recognition criteria for provisions are met. Okay, now when we refer to our general recognition criteria, remember this is in terms of IAS 37 paragraph 14. It indicates to us, 1, there has to be a present obligation which can be a legal or constructive. Number 2, it has to be probable. Remember, your keyword is probable that there will be an outflow of future economic benefits. And number 3, the amount should be reliably measured. Okay, but when we look at constructive obligation, the standard indicates to us, guys, a constructive obligation to restructure will only, listen to this, a constructive obligation to restructure arises only when an entity, 1, has a detailed formal plan, and 2, has raised valid expectations in those affected to carry out the plan. Okay? Now, I want you to add that you will have to link this with your IAS 19 principles in terms of your termination benefits. Remember, your termination benefits you will have to include in your profit before tax note. If there is a possibility of restructuring termination benefits and you recognize your provision, you will have to then debit your expense, which will be your termination benefits, and credit your provision, and only when we meet our general recognition criteria and when there is a constructive obligation, there has to be a plan and valid expectations had to be set. Let's look at reimbursements. Okay, so I've included journals, guys. Please don't write this down. You do have this in your notes. When we look at reimbursements, what is a reimbursement? Where some or all of the expenditure required to settle a provision is expected to be reimbursed by another party. Example, in the records of XYZ Limited, they raise a provision, debit the expense, credit a provision. Now we have an entity ABC that will reimburse them for this 100,000. Therefore, in the records of XYZ, they will receive the 100,000 from ABC, therefore debit bank, and credit the expense. Therefore, guys, this nets off our expense accounts. Now, the standard indicates to us that we may recognize when and only when it is virtually certain that the reimbursement will be received if the entity settles the obligation. Therefore, our key word is the fact that it has to be virtually certain. Then it should be treated as a separate asset. Yes, guys, a separate asset. The amount recognized for the reimbursement shall not exceed the amount of the provision. Okay. Let's move on to our onerous contract. Now, what is an onerous contract? How to identify an onerous contract? Now, when we look at this very basic example, we have ABC Limited that entered into a rental contract. The period is 24 months and 10,000 Rand per month payment, and the contract indicates that there is a penalty payable should they cancel this contract before the end of the 24 months of 100,000. Now, entity ABC Limited decides to cancel this contract after 12 months. Therefore, we have a remaining 12-month period. And the rent, the total rental expense for the remaining period will be 120,000 Rand. Now, IAS 37 indicates to us that when there's unavoidable costs of meeting the obligations under a contract exceeds the economic benefits of the contract. Okay? We may recognize a provision. Now, unavoidable costs. In terms of this contract, the unavoidable costs will either be the penalty or the 120,000. Now, if that unavoidable costs exceeds the economic benefits of the contract, yes guys, because no benefits will be received, because they're not going to rent that space anymore, therefore the economic benefits is 0. And then the standard indicates to us that the unavoidable costs will be the lower of the cost of fulfilling the contract and penalties. Therefore, we will have to identify in terms of fulfilling the contract, this is 120,000 Rand. And number 2, the penalties is 100,000. Therefore, a provision may be recognized based on the lower value, the 100,000, in terms of this onerous contract. We have completed our discussion in terms of our provision, and we now need to move on to our contingent liabilities. Now, a contingent liability will be when there is a possible obligation. Look at the words, guys. A possible obligation, which can be a present obligation, but the outflow is possible, but it is not probable or not reliably measured. Okay, guys, remember, what is the word probable? Probable means more likely than not. Therefore, in terms of our provisions, if it is more likely than not, more likely that a payment will occur. A contingent liability, there may be a payment, an outflow in terms of resources. But at this point of time, this is still dependent on future events. Therefore, you will not recognize a journal, but you need to include a note to indicate to your readers of the financial statements that there might be a possibility, a possible obligation to pay. Now, when we look at our contingent assets, very similar. This might be a possible asset based on the confirmation of any future uncertain, or not any, but some future uncertain events. Therefore, you will not recognize your journal entry, but you need to include this in a note, again, to the readers to indicate that there might be a possibility of an asset in future to be recognized. Disclosure. Now guys, you can refer to paragraph 84 to 92 in IAS 37 in terms of the disclosure requirements. I'm going to explain this as follows. We have our provisions and we need to recognize a provision, therefore a journal entry. This journal entry will be presented on the face of your statement of financial position as a line item. And in your profit or loss, we will have our expense. In your disclosure, which will be your note, we need to include a note in terms of the provision. You need to include your opening balance, your movement, and your closing balance. Now remember, your closing balance will correlate, and this will agree to your statement of financial position amount. And in terms of the movement, if there's a movement recognized in your profit and loss, this would agree. Now, when we compare this to our contingent liabilities or contingent assets, this is not a journal. We do not recognize a journal, but we need to include in a note the details in terms of this possible, important guys, in terms of the fact that this is possible. There is a possibility that there might be a future liability or asset to be recognized. Then in terms of our level 2 students, guys, please, you need to work through IFRIC 5. I have included the relevant details, the important topics.